Good afternoon, dear students. A warm welcome to a new video on financial planning. Now, let me explain what is financial planning. Financial planning involves preparation of a financial blueprint of an organization. It is the process of estimating the fund requirement of a business and determining the possible sources from which it can be raised. Now let us look into types of financial planning. So the first type is called long-term financial planning, and this focuses on capital expenditure for long-term growth and investment in business. This is usually between 3 to 5 years. Let's talk about short-term financial planning, and this is in the form of budget. It is usually for a period of 1 year or less. Now let us look into the objectives of financial planning. So the first point talks about ensuring availability of funds. Now let me elaborate. Whenever they are required, it includes estimation of the funds required for different purposes, that is long-term assets or working capital requirements. It estimates the time at which these funds are needed to be made available, and it also specifies the sources of these funds. Now let's go down to the second point. To see that the firm does not raise resources unnecessarily. Shortage of funds, the firm cannot meet its payment obligations. When there is surplus of funds, it does not earn return but adds to the cost of business. Now let's move into the importance of financial planning. And the first point focuses on forecasting. It helps the organization to foresee the future financial requirements in advance. Second point talks about avoiding uncertainties. Financial planning helps in meeting unexpected situations by arranging the necessary funds. Let's talk about the third point, that is coordination. Financial planning helps to coordinate the activities of all departments in the organization by allotting them necessary funds in time. Let's move to the fourth point that talks about reducing wastages. Through proper financial planning, the financial requirements will help in reducing wastages and duplication of efforts. Let's talk about the next point, easy evaluation. Financial planning helps to evaluate the actual performance of the organization based on the plans formulated in advance. Financial planning also tries to link the present with the future. Financial planning provides a link between investment and financing decisions on continuous basis. It also ensures timely availability of funds in the organization. Now, let us talk about the word capital structure. What does that mean? Capital structure refers to the proportion of debt and equity used for financing the operations of a business. Capital structure refers to the mix or composition of long-term sources of funds such as equity share capital, preference share capital, debentures, long-term loans, and reserves and surplus. The owner's fund is called as equity and the borrowed funds are termed as debt. Now in this slide, we will talk about the capital structure of a company. So the capital structure of a company may include equity shares only, or equity shares and preference shares, or equity shares and debentures, or equity shares, preference shares and debenture, or equity, preference, debentures and long-term loans. Now in this slide, we will talk about debt versus equity. The cost of debt is lower than the cost of equity, but debt is more risky than equity. Cost of debt is lower than the cost of equity as lender's risk is lower than owner's risk. Lenders earn an assured interest and repayment of capital. Interest on debt is a tax deductible expense, so it brings down the tax liability for a business, whereas dividends are paid out of profit after tax. Debt is more risky for the business as it adds to the financial risk faced by a business. Any default in the payment of interest or repayment of principal amount may lead to liquidation. So we need to be careful. Now, let us talk about this word trading on equity. Now, what does that mean? Trading on equity means the use of fixed cost sources of finance, which is preference shares, debentures, and long-term loans in the capital structure so as to raise the return to equity shareholders. It is always advisable to use trading on equity when the rate of earnings is greater than the rate of dividend payable on preference shares and the rate of interest payable on debentures and loan. Trading on equity is a practice followed by a company under which earning per share is increased by employing cheaper debt. Now you can see this, an example is given to you in this slide. 3 companies with same business and size of rupees 10 lakh capital employed. Company A used all in the form of equity. Company B used a debt of 6 lakhs at 9% interest. Company C used debt of rupees 7 lakhs at 12% interest. The earning before interest and tax for all companies are 1,10,000. Now, let us look at the interest. In the case of company A, because everything is in the form of equity, you are not paying any interest, so it is nil. In the case of company B, you are paying 9% interest, so it comes to around 54,000. Similarly, in company C, you are paying 12% interest on 7 lakhs, which is 84,000. So earning before tax in company A is 1,10,000, company B is 56,000, company C is 26,000. If we take out the tax that is given at 50%, so the earning after tax, so the tax for company A is 55,000, company B is 28,000, company C is 13,000. Now let us look at the earning after tax. So for company A it is 55,000, Company B, it is 28,000, and company C, it is 13,000. Now number of shares of rupees 100 each. So you see you have 1 lakh shares, you have 40,000 shares, and you have 30,000 shares. Now let us look at the earning per share. It is 55 paise for company A, it is 70 paise for company B, whereas it is the highest for company C. Now, what do we learn? So from the above, we learn that with a debt component which has a cheaper rate than the normal rate of return in the total capital, shareholders are likely to have the benefit of a higher rate of return on share capital. Now, which is best or optimum capital structure? Optimum capital structure is that combination of debt and equity that maximizes the market value of shares of that particular company. The capital structure affects both the profitability and the financial risk faced by a business. Now let us look into the factors affecting choice of capital structure. And the first point talks about cash flow position. The size of projected cash flows must be considered before deciding the capital structure of the firm. If there is sufficient cash flow available, debt can be always used. Second point, it must cover fixed payment obligations, like you have the normal business operations, investment in fixed assets, meeting a debt service commitment as well as providing a sufficient buffer. Let's look at the second point, which is interest coverage ratio. Higher the interest coverage ratio, which is calculated as follows: earning before interest and tax over interest, lower shall be the risk of the company failing to meet its interest payment obligation. Now let's talk about the third point, return on investment. If return on investment of the company is higher, the company can choose to use trading on equity to increase its earning per share. Now let's talk about the debt service coverage ratio. Debt service coverage ratio is equal to profit after tax plus depreciation plus interest plus non-cash expenses, preference dividend plus interest plus repayment of obligation. So, a higher debt service coverage ratio in which the cash profits generated by the operations are compared with the total cash required for the service of debt and the preference share capital, the better will be the ability of the firm to increase debt component in the capital structure. Let's talk about the fifth point, cost of debt. More debt can be used if cost of debt is low. Let's talk about tax rate. A high tax rate makes debt relatively cheaper and increases its attraction as compared to equity. Let's talk about cost of equity. When the company uses more debt, the financial risk faced by equity shareholders increases. So their desired rate of return also increases. On the other hand, let us look at the next point. If debt is used beyond a point, cost of equity may go up sharply and share price may decrease in spite of increased earning per share. Let's talk about flotation cost. The cost of public issue is more than the flotation cost of taking a loan. The flotation cost may affect the choice between debt and equity and hence the capital structure. Now let's talk about risk considerations. The total risk of business depends on both the business risk and financial risk. If a firm's business risk is lower, its capacity to use debt is higher and vice versa. Let's talk about flexibility. If the firm uses its debt potential, it loses the flexibility to use more debt. So, to maintain flexibility, the company must maintain some borrowing power to take care of unforeseen circumstances. Now, let's talk about control. Debt normally does not cause dilution of control, whereas public issue makes the firm vulnerable to takeovers. To retain control, firm should always issue debt. Thank you, dear students.